You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hello, friends and people who are just sort of acquaintances, or maybe even people who've never listened before. Hope you become a friend. I'm Don McDonald. Welcome to Talking Real Money, the radio show that becomes a podcast next week. And I'm here to, spend some time trying to help you manage money better than you did before. That's our goal and has been our goal for, such a very long time. And I'm alone today. I'm by myself. Tom is on a plane somewhere between Phoenix and Seattle. And so it's just you guys and me, which means I rely upon you a lot more. I know it's additional pressure, but I'm relying on you to join me here on the program and kind of be my wingman or woman, my semi-co-host, my asker of questions, and I'll be your answerer. 855-935-TALK is our phone number. That's 855-935-8255. It's really easy. We do it every Saturday from noon to 2 Pacific time on Northwest News Radio. And then, the nice thing about this is that next week it'll be a podcast and you can go listen again. So call 855-935-TALK, 855-935-8255. I'm Don McDonald, and I've made some of you angry. I apologize. I do. I'm really trying very, very, very hard not to be too political. I get yelled at if I say anything that even comes across as political. But when you talk about what's going on with the stock market, the bond market, the U.S. economy, the global economy, currencies, and the like, there will always be a political component to it. It's just not possible for these things to exist in a vacuum. Now, whatever the reason, and you guys know what I think the reason is. I mean, I'm in agreement with the Wall Street Journal's editorial page, for goodness sake. Those of you who think you're not moderate, I'm in agreement with the Wall Street Journal's editorial page about tariffs. But be that as it may, I know you're opposed to me giving anything that feels like a political opinion, and I'm really trying to just make it a financial opinion. But I'm going to skip all that. I want to spend time today talking about what you should do about what's happening in the markets. Because what is and has been, there is no is. By the way, there is no is. Is not a thing. It's was and may be. There's not even a will be. It's was and may be. Everything going forward is a maybe. We only know what has. What we know has happened lately is that the dollar has been volatile. Bond prices have been more volatile than a lot of people would like. And stock prices have been extremely volatile. Like all over the darn place. So there's a ton of advice out there being shared about what you should do when the markets get the what's the term in sports? The yips. They're a little yippy. Oh, is that what Trump called them? Yippy. I go there. Yeah, they got the yips. It's jumpy. And so what we hear from the mainstream financial media, and it's so funny that the old school financial media and the newer school financial media are both the same financial media. They're the same people who own Fox News. And I'm talking about the Wall Street Journal and Barron's. And Barron's gives advice that's very Wall Street focused. You know, they're telling you, 60-40 portfolio, it's no more. No good. What do you need to do now? Well, folks, if you're in the know, you should know you need to do alternative investments. Or you need gold, or you need managed futures, or you need market neutral, or whatever it might be. And they're trying to get you to buy things that, on paper, might appear attractive in the hands of the right salesperson, but in reality, they're just gimmicks. And I want to share some examples from a recent Barron's article and then a recent Wall Street Journal article. 855-935-TALK. Call me. I'm alone.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, you know, two articles could not be more different in their take on the situation we have right now with a market that, well, like most markets, has been volatile. It's just been more negative volatile. We love positive volatile. We just don't like negative volatile, and it's been pretty negative volatile. So what is the solution? Well, Barron's, of course, in their lack of wisdom, is always suggesting things that make Wall Street a lot of money. And one of those things that makes Wall Street a lot of money are they're alternative investments, really, all of them. The market neutral funds and the like, the alternative investments. And the reality is that these things, while they might do well in a bad market, the reality is that bad markets are far outnumbered by good markets. I was just looking at a chart going back to 1871 for the U.S. stock market and looking at the worst periods of for market declines. And we've had, 1 year declines. We've had a lot of those, of 1 year negatives. But when we get out to 5 years of negative returns, we've only had, 8 times in that period when we have had a 5-year negative return in the markets, and most of those have been tiny, like the return in the 2000s when it was single-digit percentages. The only really bad long-term returns were after the stock market crash of 29 in the Great Depression. So do you really even need these things? And my answer to that is, well, no, probably not. However, they're saying, well, the whole 60-40 thing, look at this. Bonds are down and stocks are down at the same time. Yes, that happens sometimes. But it's very interesting to look at the past. Now, one of the investments that was suggested in the Barron's article was a thing called the Campbell Systematic Macro Fund. This is a market-neutral fund. What does that mean? It means they short the market, they sell stocks that they don't own, hoping they go down, and then they also buy the market, buying stocks in hopes that they go up. And they leverage to do this, and they charge an incredible amount every year to do what they do, and that is 1.75% per year. It's almost 2% per year. Now, what they're supposed to do by doing that is give you a return in up and down markets and reduce your volatility. So you expect a smaller return. You're giving up some of the upside for protection on the downside, right? That's very similar to what we suggest, which is you own bonds to reduce your volatility. Now, with bonds, you don't get definite downside protection. Bond values can go down. They can. They do. We've seen that. So how do we compare these two? Let's see how they compare. This is over a 10-year time frame, not over 1 year, because your goal is generally, if you're investing, you're not investing for a year. You're investing for 5 or 10 or 20 or 30 or 40. So what's the 10-year look like from Morningstar? Expense ratio for the Campbell Systematic Macro Fund, 1.75% a year. Hard to beat that. It's hard to overcome that. That's a lot of drag on a portfolio. The Vanguard Balanced Index, on the other hand, which is just 60% stocks, 40% bonds, the whole stock market in the U.S., and the whole bond market in the U.S. Expense ratio, 0.18, or 1/10 of the expense ratio of the Campbell. Okay? So now they're at a huge advantage right there. How have they done over the last 10 years? On average, the Campbell Fund returned 3.63% per year. So you made money, and there had been a little down in there over 10 years. Not anything big. We had the COVID down. How about that Vanguard Balanced Index with those evil bonds in there? 40% evil bonds. Average annual return, 7.2. Well, so far, the Vanguard Fund doubled the returns. Double returns, 1/10 of the cost. Well, then it must be a whole lot riskier. It must be a lot more volatile. It must be more scary, right? How do we measure scary? Standard deviation. That's how we measure volatility. How much bouncing goes on. A standard deviation of 0 means no bouncing. You put $1 in, whatever the security is stays at $1 forever. It never went up and never went down. If it goes a little above $1 or a little below $1, it's going to have a tiny little standard deviation. The standard deviation on the Campbell Systematic Macro Fund is a very low, because, by the way, the S&P 500 was about 17, I think, during that period, I'm guessing. Standard deviation of a little over 11.06. 10-year standard deviation. It's pretty good. How about that evil balanced fund with just those evil bonds in it that just can't possibly protect you as well in down markets? Must be more scary, right? Must be more scary. I mean, gosh, it costs less. It's not doing anything fancy. 10.45%. Why are we getting fancy? Why are we adding complexity to our portfolios? I can only think of one reason. And that's to make the people who sell the products richer and not the person who's investing in them. I want to talk a little bit more about this later on, but you get the point? You don't need fancy. Just diversify and then learn to control your emotions. Be disciplined. 855-935-TALK is our phone number, 855-935-8255, and calls are important. That's why we're going to go talk to Jim in Tacoma. Hey, Jim, welcome to the program.
Hello. How are you doing today?
I am doing so well now that you called. Thank you.
I had someone pitch me something called a buffer EFT. I know what an EFT is, but this buffer EFT was like, I'm exposed to 15% loss. Anything below that, it's capped, but they've also capped the return on the top side.
Right, exactly.
And I'm just trying to get some information.
It's very similar. It's very. Do you know the name of it? I can give you specifics if you know the name.
No, they didn't give me a specific name. It was pitched as part of a portfolio presentation, but they just put funds into it. So they didn't go into which specific EFT or anything like that.
Okay, well, let me just look. Let me just give you some information on a general buffered. I'll just look one up. One,
Right.
just like I was mentioning in this long short fund, the expense ratios tend to be high. The ones I've looked at, let me just look at a couple. Yeah, they're all in about the 60 basis points to 1% range. They're all not very old. What they're doing is a similar kind of thing. They're hedging. They're like a hedge fund for individuals. They're trying to hedge against market declines by owning options. They're buying and selling options, which makes it more expensive and makes it more volatile. Now, I mean, it doesn't make it more volatile. It increases the inherent risk. They've got to be pretty sharp. But what it does do is it increases your costs, and it's a big, fat gimmick. The problem with the buffered ETFs right now is that they're young, and the ones I'm looking at are still, they're young, but they're for this year, they've still posted a loss. So I don't think you need them.
Tom and Don are talking real money.
You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
For your real life and real future, Tom and Don are talking real money.
855-935-8255. I'm Don McDonald. Tom is returning from a vacation, so he'll be with us next week. And so you got me. And so hopefully I have you. And if you've got a question about something money-oriented or something you'd like to share that's interesting knowledge about money, 855-935-TALK is the telephone number to use, 855-935-8255. And, you know, Jim actually raised the same issue that's the focus of today's episode, or this hour. These complex, confusing products. And they are very, very difficult for individual investors to understand. They tend to be, well, this I looked one up. I tried to find one that had a longer history, and finally during the break I found this FT, which I think this one's maybe the largest one out there. The FT Vest Laddered Buffer ETF, and it has been around since 2020. Started at the end of 2020. Hasn't made great money. Let's see, its average annual return has been about 7% over 3 years. They don't have a full 5 years yet. So 7%, 7%, 6.86%. However, let's look at the expense ratio, because that's something really critical to consider. You know, they'll say you get what you pay for. No, you don't. You pay for things you don't get. If you pay more, you're going to get less unless they take more risk. That's what I mean to say. The only way to overcome these high fees is to take more risk. And this one has an expense ratio of 0.95%. 0.95%. And its 3-year standard deviation is higher than the Vanguard Balanced Index. So is it giving you any downside that's substantive enough? In fact, let's look at the Vanguard Balanced Index and see how it is over that same period, because I didn't pull it up. The Balanced Index Fund, which is VBINX, and over that same 3-year period, it has returned a little bit less. It's returned 5%, so 2% less, with lower standard deviation of, I'd looked at it before. Oh, no, I'm sorry. That was the 10-year I was looking at, which was 10.45. So, yeah, a little bit higher standard deviation, but expenses of, come on, I do all this real time. because I can't. It's a call. I have to. 0.18. So a lot cheaper. And when you go out over 5 or 10 years, you start seeing a return that looks pretty decent. So you're not really getting anything. And that buffered fund is made up of options. And the funny thing about options is sometimes they work really well, sometimes they don't. The other problem is if you're protecting yourself during bad markets, and the last 3 years haven't been extraordinary. We've had a lot of bad recently. If you're protecting yourself from bad markets, eventually you're going to give up some upside. You can't have both sides. You can't. You may want it, but you can't have it. 855-935-TALK is our number. Greg in Florida, welcome to the show.
Hey, Don, how you doing, buddy?
I'm good, sir. How are you?
Good. I went to one of them dinners the other night.
How was the steak?
And, I had the grouper.
Oh, you went for the grouper. I don't blame you. Yeah, you're in Florida. Go for the grouper.
Yeah, I went for the grouper. The wife went for the filet mignon. And I couldn't pass it up. It was one of the best restaurants in Clearwater. It's called Bascom's. But anyway, of all people send me there, it was Schwab. And I know you have Schwab accounts, and Tom has them, and your company uses them. They're pushing something called Schwab Personalized Indexing. Have you ever heard of that?
Oh, yeah. Where you create your own index fund so that you can tax manage it better.
Right, exactly, yeah.
Yeah. I can't believe Schwab's doing a free steak dinner for that.
Oh, yeah. Yeah, wow. They sure did.
Well, tell you what, hang on with me because I want to hear more about this because I'm shocked that they did that. But I've got to take this break, so please stick around. 855-935-TALK. That's the phone number, 855-935-8255.
Tom and Don are talking real money.
Brace the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. We'll even give you a $100 credit on your next campaign. Get started today at linkedin.com/results. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
Welcome back to the solo show. Don McDonald alone on Talking Real Money and Talking Real Money, actually talking about it with people, maybe with you. If you call 855-935-TALK, 855-935-8255. We're talking to Greg in Florida, around Clearwater, over on the West Coast, who got invited to a steak dinner, but not from an indexed annuity salesperson, which is unique. He was invited by Charles Schwab, probably because you're on a list of very high net worth investors, Greg. That's my guess. And you were pitched.
Not that high.
Well, but you're on the list. You somehow made the list. And what they're talking about, what's their personalized indexing? It's what's called in the industry direct indexing. It's something that a few years ago was really hard to do, but today is really easy because of the power of the computers involved. So it's not that complex a process. It works really well for people with large portfolios, and I am talking mid seven figures, at the very least low seven figures and up, because it has a higher cost associated with it than just using an indexed ETF that can cost you less than 10 basis points. The advantage is only found in a taxable account, because you can use direct indexing to tax loss harvest and to make some tax decisions to offset some capital gains that were realized in the portfolio by selling some things at a loss and moving money around short term. Some people use direct indexing as a means by which to create an actively managed portfolio, and that's where it really gets bad. Schwab does not do that. Vanguard also, by the way, direct indexes too now. So they're doing it. I think what makes this thing with Schwab unique is that they went for the steak dinner, figuring, I don't know how else to get to these high net worth investors.
Well, it isn't that you can get in for 100,000 up to
that's their minimum, but I disagree with that because I don't think the 40 basis point extra fee is going to be mitigated by the tiny little tax advantages at a $100,000 portfolio. We offer it too at Apella. We offer direct indexing, but we don't suggest it for anything but large accounts. Large accounts.
I see. Well, the one problem I have is I have a whole lot of company stock that I have a lot of big capital gains. So I wanted to start getting rid of that and then maybe do this to get the tax loss. But I guess you're only allowed $3,000 tax loss a year anyway, aren't you?
Against ordinary income. Yep. Yeah, it directly offsets capital gains. And what is more important, I think, than jumping into Schwab's program? Because, again, this is a piecemeal approach to planning. I think it's far, far, far better for you if you have – do you have a financial and a tax plan now, particularly in your situation because you have company stock?
Well, I make it up myself.
Well, that's not a terrible thing, but I think at this point you may either want some guidance from a true fee-only advisor, which, by the way, you could get at Schwab. You could hire one at Schwab. Or you can get your own, or doing it with your CPA, because you do need some sort of a tax strategy to at least reduce the gains and keep you from being taxed at higher brackets going forward as you sell off that company stock. And I'm in a similar situation. And I just eventually you get to the point where you have to have a plan. When we get older, it's one of those things.
Right. Like one of your callers said that she met that lady named Irma. I've been meeting Irma, and I'm getting tired of meeting her.
Yeah, I don't blame you. Irma is she's an expensive date.
Yeah.
Yeah, you could get a lot of steak dinners for what you pay on Irma.
Oh, heck yeah. Yeah.
But I would really start. I think I'd go to a plan somewhere, somehow, pay the $5,000 or so, which is what they typically cost, and get a good plan, even if you want to manage it yourself. Again, the long term, the 40 basis points. It depends on the size of your portfolio. It could very well be worth it. I like direct indexing, but only for those bigger accounts. So, thank you so much for the call, Greg. Hope you enjoyed the dinner. When you're on the coast, you can have the grouper. 855-935-TALK is our phone number. Don't go away.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at talkingrealmoney.com or call 800-386-3004. That's talkingrealmoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Apella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
On the only radio program or podcast you should listen to. Well, one of the only. There are a couple. You can listen to Stacking Benjamins. We like them. 855-935-TALK is our phone number, 855-935-8255. Just don't listen to some of those other ones, okay? Let's, we're going to spend some time in Washington now, as we should. That's where our station is. Let's go to Olympia. Laura, welcome to the program.
Thank you for having me.
My pleasure. What's up?
I bought a house 14 years ago and always figured that I would use it at some point to supplement my retirement. Now with all the craziness in the stock market, I want to sell my house. It's too big and too much to heat now. But I'm wondering if it's a good time to sell it or not, because the majority of the money I would be putting into my retirement accounts, and I just don't know if it's a good time.
Here's the thing. It's always a good time because we don't know the right time, and we will never know the right time. Your timing will never be impeccable. However, the fact of the matter is that over the course of the past many hundreds of years of markets trading stocks and bonds and the like, there has never been a protracted period, more than a few years, when you would have lost money in the stock market, particularly. The bond market, like almost never. So investing, if you do it right, it's the right time to do it. You just have to do it disciplined and then be patient with it and build. You don't start by investing. You start by figuring out how you should be investing. But I love the idea of you're very concentrated in real estate. You've got a lot of money in it, right?
Yes.
If you diversify your portfolio, you're going to own some real estate, but you're also going to own some oil and some gold and some gas and some pharmaceuticals, and you're going to own all these wonderful pieces of the economy. And unless you believe that the global economy is going to collapse and stay collapsed forever, then it's always a good time to invest.
Well, I have about the same in my retirement accounts that I would clear in my house.
Okay, good. So you already have some diversification, but but the fact of the matter is you'll have even better diversification. And as you say, the house is too big. And renting a house is like a job. I don't care what anyone says. It is not passive income. It's hard work. Houses, you have to deal with tenants. They're a pain. Sometimes you have to deal with repairs and maintenance, which are a pain a lot of time. Often you have to hire a manager, which sucks down some of your return. And you can have a house that remains vacant for a long period of time. And then it's draining your capital and it's tying up a big chunk of capital.
Yeah. No, I just want to buy the house, or I want to buy a much smaller house. Mm-hmm. And then use the remaining money to put into my retirement. It seems like this is sort of a crazy time to put.
But it always feels crazy. I'm telling you, if you think back to 2020, think back to COVID, it seemed crazy then. And everybody was thinking this is a terrible time to invest, and it turned out to be a really good time. 2008, 2009 seemed like a horrible, horrible time to invest. But if you had started investing during that downturn, you would have made a ton of money. A ton. We don't know where the turnaround will come. It could be that we have a year or two or three of bad markets. But you're not going to be putting it all in today. You're not even going to get it for a while.
Well, and that's what concerns me is in the past, with the downturns, I've had that time to rebuild it, but I'm 68, and I'm concerned that if I put too much into my retirement, am I going to have time to rebuild it?
Well, that's where you'd have to change. That's where a plan comes in so handy. I am the exact same age. And I have, over the past few years, been adjusting my portfolio to emphasize bonds more than stocks. In that way, the volatility is not going to be as great as if I had it entirely in stocks, making it less scary and also making it take less time to recover. Because if you don't have as big a decline... Go ahead.
I have someone that I really trust that's been doing a really good job.
Okay. What kind? Do you remember any of the names of any of the products that are in your portfolio?
It's Schwab.
So you have an advisor at Schwab?
Yeah.
Or who works with Schwab? Okay. And do you know what they charge you a year?
I don't. I know that they're a fiduciary.
Good.
And
okay.
It's never Yeah.
Then again, you have guidance, which is, geez, I mean, in my opinion, that's 75% of the battle. The guidance is more important than the portfolio. Having somebody who can keep you on track and continue investing when it feels bad is invaluable. You got to have it, and you have it. So you're in great shape. I would sell the house. You're selling into what is still a pretty strong real estate market in the Northwest. You're going to be getting good money out of the house, better than you would have gotten out of it 3 or 4 or 5 years ago, which is a bonus. Well, see, then had you taken it out a few years ago and invested it, you would have been worse off than you are now. So you'll be investing it. Maybe it goes down. It's not going to go down by half, probably. Not if you're balanced.
Yeah. Okay.
All right.
All right. That gives me a little hope.
Oh, I think you're in great shape. More than a little hope, a lot of hope. Thanks, Laura. 855-935-TALK, 8255. Sammamish is next. Jason, you're on.
Good afternoon, Don. Jason,
hey, Jason.
Tesla Bull.
Oh, the Tesla Bull. How's it going? I haven't looked at Tesla.
I'm my Tesla bullishness is substantially down from what it was, but I'm not calling about Tesla today. So I have a question about, I've never done, always been scared to do calls. I know you're probably not the biggest fan of calls, options, but I do have 100 shares of a stock that's done really well of late called Palantir, which I'm sure you're familiar. I only have enough to do one contract, so I'm dipping my toe very lightly into options. So I want to get your take on premium farming. So I sold a call option for about $125. The stock is currently in the mid-90s, and for 3 months out. And I got about $500 of premium. So I have another friend that kind of talked me into this, or has been doing this for a while and had moderate success with it. And basically the concept, I want to get your thoughts on the concept of premium farming and taking that premium and buying into diversifying into like an ETF. I took the 500 and bought several shares of another ETF that I have called VONG, which I don't know if you're a big fan of that ETF, but anyway, it's Vanguard.
I got to look it up.
Yeah. So
VOMG.
The premium that I have is VON like Nancy G.
Oh, VONG, VONG.
Yeah.
Okay, so
it's done quite well lately. It's been hit hard lately with tech. It's very tech heavy, but anyway, I just wanted to get your thoughts on the concept of that and using the premium to buy into something more diversified like an ETF.
Okay, well, the second part I'm in favor of. The first part, hang on, we'll be back. 855-935-TALK is our phone number.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
All right. 855-935-TALK is our phone number, by the way. We're talking to Jason, who goes by the name Tesla Bull, but he's no longer a Tesla Bull. And we had some interesting discussions in the past with Jason about his gambling habit. And Jason, sounds like you're still a bit of a gambler.
I mean, I'm being very cautious. I'm using covered calls. I'm not trying to do anything too fancy.
I know, but let me tell you a little story. We don't have a lot of time, but when I was a young man in my late 20s, early 30s, I was a stockbroker with a big firm. And my friends and I all got together and came up with what we thought were brilliant covered call writing strategies. Now, again, I like the fact that you're taking some of the money you're making and you're putting that into a more conservative investment. But let me tell you, eventually every strategy I have ever seen over my 40 some odd years in this business have failed eventually. And they don't announce their failure. Covered call writing works.
Sorry.
Sometimes.
I just have one more thing to add to it. I said that the other thing is my cost basis is very good. It's down in like the 30s or 40s. So my cost basis is good, and I would still, even if it executes at 125, it goes in the money and it executes at 125, I would be I would have made a good amount of money on the call. So I'm still,
no. You can get lucky and do really well, and you're doing well. I'm saying I'm not denying that you're doing well now, but it's kind of like the gambler who is a very good gambler, by the way, a very good gambler. They play blackjack. They are decent at counting cards. They let it ride. Eventually, though, the house is going to kill them because something happened that they did not anticipate. And that's my only concern. If this is money you can play with, it's still playing, no matter how conservative you call it, then who might argue it's your money. Do what you want. I just think longer term, going out decades from where you are today, that you would be so much better off and probably have so much more time for other pursuits if you just bought indexes. And then, I don't know what you do for a living, but I'd probably, as smart as you are, I'd probably do more of that.
Well, I have other more conservative things as well. Like I told you, I have some of the Vanguard target rate funds, the Vanguard BCI.
It seems like you're working really hard.
But Don, I'm not. This is just a one covered call for 3 months out. I just said it.
I know, but you're talking about it as if it's a strategy.
No, it's just a way to get it $500. I mean, hey,
Okay. And that's what. Okay. Now we're back to it's fun, cool. It's so. But I don't want. Here's the thing. I've got to be careful of. But here's the thing. I got to be careful of, Jason. Do you know that other people are listening to us right now?
I do.
I don't want any of them to do the same thing you're doing, unless it's purely for fun. But I appreciate the call, and we are running out of time because the hour ends when the hour ends, and I can't make it any longer. If you want more information on our podcast, just go to talkingrealmoney.com. If you want to ask questions other than during the show, which you can call every Saturday from noon to 2 Pacific time, 3 to 5 Eastern at 855-935-TALK, just go to talkingrealmoney.com, click the contact button, and you can send us a note. And if you want a little bit of help for free for nothing with no cost, no obligation, no high-pressure sales pitch from a real live fiduciary advisor, just go to talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?